Hello. Welcome to our next chapter, that is your deduction under chapter 6A. So now these deductions you get from your gross total income, that is your GTI. So what one point you have to remember, that deduction under chapter 6A. So this chapter is divided into two parts. One is your payment based deduction, and second is your income based deduction. So first we will be doing payment based deduction. So under this chapter, that is chapter 6A deductions, it will be restricted to gross total income, which means if your gross total income is, say for example, rupees 15 lakh, then under no circumstances can you get chapter 6 deductions more than rupees 15 lakh. That is, it will be limited only and only up to your gross total income. Your GTI will never go negative because of chapter 6 deduction. And your second point that you have to remember, it is not allowed against section LTCG 112, that is your normal long term capital gain section. LTCG 112A, that is your securities one. SPCG under section 11A, of course, your securities short term, and any special rate income there will not be any deduction allowed. Chapter 6 deductions will not be allowed against these incomes. Okay, so coming to your first point, that is your payment based deductions. On the payment based deduction, your first section is your section 80C, very common section and frequently asked in papers. Section 80C talks about specified investment. That is, if you have invested at some place which is specified, you will get a deduction of rupees 1,50,000. That is based on the amount of money that you spend only, it will be limited up to 1,50,000. Another point that you have to remember is section 80C, 80CCC and 80CCD1. All of these sections combined limit is also 1,50,000. So if you read over here, it is 1,50,000, over here it is 1,50,000, and over here 80CCD1 also there is some other amount. So all these three sections together will be limited up to maximum 1,50,000. Okay, so coming to your first point, that is your life insurance premium. Your life insurance premium paid for self, spouse, or children. So either you, your husband slash wife, or your children, if you have paid the life insurance premium, that will be allowed as deduction. Now, how much deduction will be allowed? If the policy was taken before 1st April 2012, if the policy was taken before 1st April 2012, it will be lower of premium paid or 20% of policy value. That is, whatever the policy value is, you calculate 20% of it, and whatever premium you have paid, it will be lower of that amount. If the policy was taken on or after 1st April 2012, so remember 1st April 2012, if it is before 1st April 2012, your percentage is 20%. However, if it is after 1st April 2012, your percentage becomes 10% of policy value. And last is if it is on or after 1st April 2013. Remember over here the year is 2013. For a person with disability or disease, if the person is disabled or he has some disease, then in such a case it will be lower of premium paid or 15% of policy value. Okay, so this is your section with regards to your life insurance premium. Then next is any amount deposit in your public provident fund, statutory provident fund, recognized provident fund, or any approved superannuation fund. Whatever amount you have deposited will be allowed as deduction. Any amount invested in your NSC, that is your National Savings Certificate. Repayment of loan for construction of house. Under this point you have to remember, you will get a deduction if suppose you are constructing any house, you have taken a loan. Now when you repay this loan, whatever payment that you will be doing towards principal, that will also be allowed as a deduction. But the point that you have to remember, that institute usually confuses, the deduction that you will receive is only after construction of the house is completed. For example, if the construction is still going on and you already start repaying the loan, then you will not be getting any deduction. So this deduction will only be available to you after the house has been completed. Okay, so remember this while solving questions. Next is your tuition fees paid for education of children. Remember, it is not school fees, it is only tuition fees. Tuition fees means the schools charge you some tuition fees, then there are extracurricular activities fees, etc., etc. So only the tuition fees portion of that school fees will be allowed as deduction. Next is your deposit in the bonds of now, but this is of course your agriculture, rural development bonds. So any deposit that you've done in them will be allowed as deduction. Next is your deposit in senior citizen saving scheme. Contribution to unit linked investment scheme. If you made any contribution, that will be allowed as deduction. Buy any notified units of mutual fund or UTI, that is your unit trust of India. Next is your deposit in your Sukanya Samriddhi scheme account, and last is stamp duty for acquisition of house property. If you purchase any house property and you paid stamp duty for the acquisition, then the stamp duty that you paid will be allowed as deduction under section 80C. So remember, all of the deductions club maximum 1,50,000. Okay, coming to your next section, that is section 80CCC. This is also under the cap of 1,50,000. That is your LIC pension fund. And last, under this 1,50,000 cap comes your 80 section 80CCD1. 80CCD1 is your pension scheme of central government for two people. One is your salaried employees and other individuals. So if you are a salaried employee, the deduction that you will be allowed is lower of employee contribution or 10% of salary. Deduction that you will be allowed is employee contribution, that is how much the employee has contributed from his salary, and 10% of salary, whichever is lower. Now, sir, what does salary mean over here? Over here, salary means your basic plus dearness allowance. Okay, so 10% of salary is under section 80CCD1. However, if you are other individual, that is, if you are not a salaried employee, then in such a case, it will be your SSC's contribution, whatever amount you have contributed, or 20% of your gross total income, whichever is lower. Okay, so 20% of gross total income. Then section 80 CCD 1B is a special section because this gives you an additional deduction of 50,000. So additional deduction of 50,000 other than section 80 CCD 1. So under 80 CCD 1, since 80 CCD 1 already comes under the 1,50,000 limit, therefore section 80 CCD 1B can be utilized for additional 50,000. For example, if there is an NPS contribution, if there is an NPS contribution of say rupees 1,40,000 and your gross total income is 5,50,000. So of course under section 80 CCD 1, you will calculate 20% of GTI. So 20% of 5,50,000. So these are your two options. That is option 1 and option 2. So 20% of 5,50,000 comes to rupees 1,10,000. And since under section 80 CCD 1B, you have invested the remaining 30,000, because out of 1,40,000 you use 1,10,000 over here. So remaining 30,000 you will be able to use in section 80 CCD 1B. Okay, so 30,000 you will be using here. Your other option available with you is you use your section 80 CCD 1B complete 50,000. So this complete 50,000 you have used over here, and therefore under section 80 CCD 1 only 90,000 will be counted. Now what is the benefit of this? That is section 80 triple C and 80C will be allowed to use the balance remaining 60,000 over here in this case. However, in this case, they will only be allowed to use 40,000 because of your total 1,50,000 cap. So therefore, first utilize 80 CCD 1B to the full extent of 50,000 and then use these sections 80C, 80 triple C and 80 CCD 1. Clear? So I hope it is clear with this example. As I told you, section 80C, 80 triple C and 80 CCD 1 have a maximum deduction of 1,50,000. Okay, so we are done with this part. Let's scroll through. Next is your section 80D. Now, how do you remember 80D? 80D is for disease. So any medical insurance premium, preventive checkup or medical treatment, if you have spent any amount for medical insurance premium, preventive health checkup or your medical treatment, this comes under section 80D. Now, who will be allowed that deduction? What you have to remember over here is self, spouse, parents and dependent children. If you remember over here, I have not written dependent children under section 80C. If you remember, I had only written children. That is because it does not matter whether they are dependent or not, deduction will be available. However, under section 80D, what you have to remember, it is self, spouse, parent, and dependent children. That is only and only if your children are dependent on you, only then will you get this deduction. Mode of payment, any mode other than cash, you will get deduction only if you made through any mode other than cash. However, there's an exception that your preventive health checkup that can be paid in cash, that is allowed to be payment, that is allowed for payment to be made in cash. So now this is a little complicated section. So to make it easier, I have divided it the people into two groups. So first group is you, your spouse, and your dependent children. This is your group one, and your second group is of your parents. So usually each group gets a deduction of rupees 25,000. That is your deduction that is available. However, if the age of any person in the group, that is in group 1 or group 2, if the age of any one person is also greater than or equal to 60 years, then this deduction from 25,000, instead of 25,000, the deduction amount will become 50,000. So if any one person from that group is 60 or more, then instead of 25,000, the limit will become 50,000 for the entire group. So aggregate deduction for preventive health checkup for group 1 and group 2 is maximum 5,000. That is whatever amount you have spent towards your preventive health checkup. For example, it is 3,000 in group 1 and 4,000 in group 2. So coming to a total of 7,000. So this 7,000 total, you will not be allowed a deduction. You will only be allowed a deduction of maximum 5,000 because this is what the provision says. So this will be limited to 5,000. Okay, next is your section 80DD and section 80U. So section 80DD and 80U are the same, just that section 80DD is for dependent relative, whereas section 80U is when the SSC himself is when the SSC himself is handicapped. So therefore, section 80DD is handicap dependent relative. So how do you learn this? You learn this as Dukhi and dependent. So therefore, handicap dependent relative. So 80DD is if the relative is handicapped or dependent. 80U is if you yourself, that is the SSC, is handicapped and dependent. Okay. Now, what do you have to remember over here? Relative. When I say dependent relative, your relative means your spouse, children, brother, sister, and parent. That is your husband, wife, your children, your brother, sister, and your parents. All of these, if only they are dependent, will you be allowed as deduction? Because section 80DD. So what you have to remember is dependent and Dukhi dependent. It has to be dependent. Okay. Now, if it's a normal disability that is less than 80%, this percentage will be given to you in the question. If it is normal disability deduction, you will get a flat deduction. There is no limit over here as how much you spend, etc. Nothing. There's a flat deduction of rupees 75,000. And if there is a severe disability, that is if it is 80% or above, in such a case, you will get a flat deduction of 1,25,000. Okay. And deduction will be reversed if such relative received annuity before death of the SSC. This is the amendment that has been added. That is whatever deduction that has been received, this will be reversed if he received annuity before the death of the SSC. Okay, this is your May 23 amendment. Now coming to your next section, that is your section 80DDB. 80 DDB talks about medical treatment of dependent relative. How do you remember DDB? DDB is Dukhi, dependent, and Bimar. So remember over here also it is your dependent relative, and again your relative over here is self, spouse, children, brother, sister, parent. Self over here, your self is extra because section 80 you had self as different. So therefore otherwise it's the same: spouse, children, brother, sister, parents, spouse, brother, sister, children, parents. Okay, so your relative definition remains the same, just that under 80 DDB, you is also included. Okay, now over here, the deduction that you will receive is actual expenses or 40,000, whichever is lower. That is what is the actual amount that you have spent versus rupees 40,000, whichever is lower. However, instead of 40,000, it will be 1 lakh if it is a senior citizen. Okay, so instead of 40,000, this 40,000 has to be read as 1 lakh if it is a senior citizen. Okay, coming to your next part, that is interest on loan for higher education. That is section 80E. How do you learn this? Section 80E. E stands for education. So interest on loan for higher education, there is no limit on the amount of interest deduction that you will receive. It is for self, spouse, and children. That is, you can either take it for yourself, for your spouse, or for your children. Okay. Now, interest for a period of 8 years from when SSC starts paying interest, you will get a deduction from 8 years from when the SSC starts paying interest. Okay. Now, coming to your next part, that is your section 80EEA. 80EEA talks about interest on housing loans. 80EEA talks about if there is a loan, if there is a loan taken between 1st April 2019 and 31st March 2021. Remember the dates: 1st April 2019 and 31st March 2021. And your house SDV, that is your stamp duty value, is up to rupees 45 lakh. Is up to, that means if it is more than 45 lakh, this section will not be applicable. It has to be up to 45 lakhs. And the SSC owns no other house. That is this house that he is purchasing. Apart from this, he owns no other house. Then on the interest component, he will get a maximum deduction of rupees 1,50,000. Clear? So loan should be taken between 1st April 2019 and 31st March 2021. And the SDV should be up to 45 lakhs and SEC should own no other house. So this is your section 80 EEA. Coming to next section, that is section 80 EEB. 80 EEB talks about interest on electric vehicle loan. So how do you learn this? It is electric vehicle. Okay, so EEB, electric vehicle, that is interest on electric vehicle loan if loan is taken between 1st April 19. Remember over here also it is 1st April 19, but over here this is 31st March 2023, while over here it is 31st March 2021. So 1st April 19 to 31st March 2023 in case of electric vehicle loan. Over here also your deduction is 1,50,000 on the interest component. Okay, now coming to your section 80G. 80G talks about donations. If you made any donations, okay, so if you made any donations, that is your, so donations are divided into 4 categories. That is your 50% limited, 50% unlimited, 100% limited, and 100% unlimited. Okay, so these are your 4 sections. So coming to first, we will do the limited part because it is easier to learn. So under 100% limited, if any donation to government to promote family planning. Okay, so if you made any donation to the government to promote family planning, or if you made donation by a company to any Indian Olympics Association, remember it is donation by company to the Indian Olympics Association, this will come under 100% limited deduction. Now what comes under 50% limited deduction is your HDC mobile. Okay, so it is your HTC mobile. How do you learn this? It is HTC mobile. Now donation to Housing Development Authority. Okay, so H for Housing Development Authority. Donation for renovation or repair of temple. Okay, so this H over here is housing, this is temple. Now donation to public charitable trust. Okay, so this is your charity. And last is your minority, that is donation to promote minority community. How do you learn this? You learn this at HTC mobile. So all of these come under your 50% limited. So under 100% limited, it is family planning and Olympic, that is your FO. So how do you learn this? It is called FO HTC mobile. Okay, FO HTC mobile. FO comes under 100% limited and under HTC mobile comes 50% limited. Okay, now what are the donations where 100% unlimited deduction? So why do we call these limited deductions? Because they will be restricted to some point. While your unlimited deduction, there is no limit. That is whatever amount you donate, full amount will be allowed as deduction. Okay, so under 100% unlimited, how do you remember this? Your National Defense Fund, your PM National Relief Fund, Dila Saksharta Samiti, National Sports Fund, National Children Fund, PM Armenia Earthquake Relief Fund, National Fund for Drug Abuse, PM Care Fund, PM Relief Fund, Clean Ganga Fund, Fund for the Army, and Swachh Bharat Post. Okay, so these usually are your entire if you want to identify them. First hint is if it has the word national. If you see, most of these ones have national. Okay, so if they have national word, put it under 100% unlimited. Okay, and the more times you read this, it will be easier to learn. Okay, so this is your 100% unlimited, and next is your 50% unlimited. So under 50% unlimited is basically all your prime ministers, your Jawaharlal Nehru, Indira Gandhi, Rajiv Gandhi, all of these have been prime ministers. And next is your PM drought relief fund. Okay, so I hope this is easy to learn your 50% unlimited. Okay, now sir, how do we use the deduction? So I've also given an example. So for example, your total donation will be limited to 10% of ATI. Why do we call this limited? Because your total donation will be limited to 10% of your ATI, that is your adjusted total income. Your ATI is your GTI, that is your gross total income, minus all other chapter 6A deduction, that is your gross total income. After you subtract all 6A deductions, this will be called your ATI. And 10% of that ATI will be allowed as deduction for your limited donations. Okay, so let's solve a question. For example, the amount that you donated in the 50% limited was rupees 50,000, and in the 100% limited was rupees 25,000. So now the total amount that you have deposited is nothing but 75,000. Now 10% of ATI, for example, comes to 45,000. For example, your ATI came to 4,50,000. So 10% of 4,50,000 will come to 45,000, whichever is lower, because we will restrict it to 10% of ATI. So 45,000 will only be allowed out of the 75,000 that you have made. Only 45,000 will be allowed. So now this 45,000 will be broken up into that I have made 100% limited deduction of 25,000. This 25,000 I will fully utilize that, boss. If you are only allowing me 45,000, of course I will use the entire amount that I've made towards 100% under this. So therefore this full 25,000 I have considered as 100% limited, and the remaining 20,000 that is left, that I will consider under 50% limited. So therefore the deduction that I will actually receive is 100% of 25,000 plus 50% of 20,000, that is your 10,000. So deduction that you will receive is 35,000 after making a donation of 75,000. So I hope this example is clear with you. Coming to our other deductions, that is your 80GG. 80GG is basically Ghar Grahasti, therefore GG. So rent paid on house property. There are three limits that you have to remember. First is your 5,000 per month. Okay. Next is your 25% of adjusted total income. Over here also adjusted total income is the same as section 80G, that is after subtracting all 6 deductions. So ATI is same as 80G, and this person should not be receiving HRA, that is your house rent allowance. Only then will this person be allowed a deduction of rent paid on house property. So 5,000 per month, 25% of adjusted TI or rent paid minus 10% of adjusted TI. So 5,000 per month, 25% of adjusted TI or rent paid minus 10% of adjusted total income, whichever is lower. So you have to remember all three limits, and then you have to do lower. This is the deduction that you receive under section 80GG. Now coming to the next section is your section 80GGA. So 80GGA talks about donation for scientific research or rural development, that is your 80GGA. So 100% of donation will be allowed, and cash donation will also be allowed if it is up to rupees 2,000. So cash donation will be allowed if it is up to rupees 2,000. Over 2,000, cash donation will not be allowed. The next section is your section 80GGB. Now section 80GGB talks about donation to political parties and electoral trust. Okay. Now 80GGC also talks about donation to political party and electoral trust. What you have to remember is 80GGB is for Indian company, while 80GGC is for any person other than Indian company. Correct. So if an Indian company donates, it is section 80GGB. If any person other than Indian company donates, it is section 80GGC. Now 100% deduction will be allowed, but cash is not allowed. Over here also 100% deduction, cash is not allowed. Over here, donation and contribution both are allowed. That is, for example, what is the difference between donation and contribution? So for example, if you have made any donation, if the Indian company has made any donation for an advertisement in the political party souvenir, in such a case, they will be allowed a deduction because that is called as contribution. Okay, so if you have made an advertisement in their souvenir, that will be called as contribution, and that will be allowed as deduction. This deduction is only allowed to companies. Over here, if you say I have written only donation, because contribution, if an individual makes any advertisement in that souvenir, he will not be allowed a deduction. He will only be allowed deduction for donation. He will not be allowed any deduction for any advertisement or any contribution in any other form. Okay. So I have written advertisement in political party brochure is your contribution, so that it is easier to understand. Okay, so this is point that you have to keep in mind. Coming to your last section under payment based deduction, very important section. So that is your section 80JJAA. So 80JJAA talks about employment of new employees. So if you hire new employees in your company, you will be allowed 30%. You will be allowed, of course, the salary that you are paying, that is already allowed as deduction, but you will be getting additional 30% deduction under some circumstances. So SEC's business to whom section 44AB applies, that is basically if your turnover is more than 1 crore, so only they will be eligible for this section, and they will get 30% additional employees cost deduction for 3 years. That is only on your additional employees. You will get 30% additional over and above the normal deduction that you are receiving over their salary. You will get 30% on their salary, even more. That is basically 130% of someone's salary only for your additional employees for a period of 3 years. Okay, now your number of employees will be closing minus opening. That is, for example, if you started the year, you had 100 employees, and at the end of the year, for example, you have 127 employees, then new employees will be counted as 27, because 27 people is the net. Irrespective of how many people left and joined, only 27 people will be counted as new. Your salary will be less than or up to 25,000. That is, these employees that are there, their salary should be maximum 25,000 per month. Only then they will be allowed a deduction under this section, because the government wants that my new people, more unskilled people who have been employed, so that there is more employment generation. So you will only and only if their salary is less than or up to rupees 25,000 per month. They have to be employed for 150 days. So if your business is apparel, that is clothes, any leather related or footwear related, for them the number of days that they have to work for the company to be eligible for the 30% extra deduction is 150 days, and for others it is 240 days. So it is usually 240 days, but for people who are in the business of apparel, leather and footwear, if this person has worked for more than 150 days, only then section 80 JJAS deduction will be available. Okay, this deduction is available to the company, and employee must participate in any recognized provident fund. So these are your conditions to gain your extra 30%. So 240 days, 150 days, 25,000 only on new employees, 30% deduction, and employees must participate in your recognized provident fund. That is your condition for section 80 JJAA. So these are the end of your payment based deductions. Coming to your income based deductions. So your income based deductions start with section 80QQB. So 80QQB and 80RRB are very similar sections. So let's do them together. That is royalty on books and royalty from patents. Okay. So royalty on books, you will get lower of rupees 3 lakh or the royalty received, whichever is lower. Over here also it is 3 lakh or royalty received, whichever is lower. Now over here, what does royalty? For example, if the royalty that you received is one lump sum, that is one time payment you have received as loyalty. So if you receive the lump sum payment, the amount received will be called your royalty received. However, if it is a not lump sum, if it is based on each sale, then it will be 15% of value of books sold. Okay, so 15% will be the thing that we will be considering for your deduction. Clear? So 80 QQB and 80 RRB. So QQB stands for Kitab book. That is Kitab. Instead of Kitab, to learn this, you can learn it as Kitab. Okay, so kitab book, and 80 RRB is royalty from patents. Clear? If it is received outside India, if this royalty, this is for both sections. Okay, so if you receive this royalty outside India, deduction will be allowed if brought to India within 6 months. Only and only if this income has been brought to India within 6 months, it will be allowed the deduction. Otherwise, we will be taxing it. Okay. Now next is your section 80 TTA and 80 TTB are both again very similar sections. 80 TTA talks about interest on savings account, and 80 TTB talks about interest on deposit. So if you are an individual whose age is less than 60 years, then you come under section 80 TTA. You will get a deduction of lower of rupees 10,000 or interest amount, whichever is lower. Whatever interest you earn on your savings account or rupees 10,000, whichever is lower, that is the deduction that you will get under section 80 TTA. Of course, your account will be with bank or post office, and individual age less than 60 years. Over here, this instead of 10,000, it becomes 50,000. Why? Because individual age is greater than 60 years. It is equal to greater than 60 years. Then this amount of 10,000 will become rupees 50,000. Clear? So that is the section 80 TTA and 80 TTB. Remember, 80 TTA is only interest on savings account, whereas this is any deposit that you make. Okay. Coming to your next section, that is your section 80 JJA. 80 JJA is income from collecting, processing biodegradable waste. So any income that you earn from this business, 100% of income for 5 consecutive years from when business commence will be allowed as deduction. Okay, so entire 100%. Next is the section 80 IBA. So 80 IBA talks about building housing projects. Okay, so building housing projects, 100% of profit will be allowed as deduction. Project should be approved between June 2016 and March 2021. It is a comparatively less important section. So from between June 2016 and March 21, if the project has been approved, then it will be allowed as deduction under this section. Next is it should be completed in 5 years from date of approval. From whenever the approval has been received, it should be completed within 5 years. If the area is more than 1,000 square feet, equal to or more than 1,000 square feet in Mumbai, Chennai, Kolkata, Delhi. So these are your tier 1 cities. So and only if it is greater than 2,000 square feet in other cities, only then you will be allowed as deduction under this section. So 1,000 for your MCKD. Okay, that is a Mumbai, Chennai, Kolkata, Delhi, and for others it is your 2,000 square feet. Okay. Next section is your 80 IAC. 80 IAC talks about deduction for new startup. So 100% of profit, 100% of profit for 3 consecutive years out of 10 years. So any 3 consecutive years they can choose out of 10 years from when the business has commenced. So if the business has commenced, say for example in 2000, then for the next 10 years, out of the next 10 years, only any 3 years. But it should be incorporated between April 2016 and March 2021, only then will the deduction be allowed. It has to be engaged in innovation, development, or improvement of products, and turnover has to be less than or equal to 100 crores in previous year in which they are claiming the deduction. So any three consecutive years out of 10 years, turnover has to be less than or equal to 100 crores. Okay, and it should be engaged in innovation, development, or improvement of product. Okay, next is your section 80LA. 80LA talks about offshore banking unit or IFSC. So any OBU, so any bank branch located in SEZ unit, any bank branch which is located in your SEZ unit, 100% of deduction for the first 5 years and 50% deduction for the next 5 years. This is what the OBU will be getting. Okay, and for IFSC, that is your International Financial Service Center, 100% of deduction in any 10 consecutive years out of 15 years. This is the deduction that they will be receiving for 10 consecutive years out of the previous 15 years. Clear? So this is for your IFSC, and for OBU it is 100% in first 5 years and 50% in the next 5 years. And coming to our last part of this chapter, that is section 80M. We have also studied this topic when we did our dividend chapter. I'll do this once again. Intercorporate dividend deduction. That is, if any domestic company receives dividend from another domestic company, from a foreign company, or from a business trust, if a domestic company receives any dividend from these three companies and it distributes this dividend to its shareholder, then in such a case it will be allowed some deduction. So deduction will be lower of dividend received, that is dividend received from these three, or dividend distributed by the domestic company up to 1 month before 139(1) due date. 139(1) is basically your ROI due date, that is your return due date. So dividend distributed by domestic company up to 1 month before your 139(1) due date. Okay, so your 139(1) due date minus 1 month, that is whatever this is the time period, any payment that it has made, any appropriation, any dividend that it has distributed to its unit holders before this due date, that will be your amount of deduction. So dividend received or whatever amount you have distributed before this date, whichever is lower. And with this, we are done with our chapter 6 deductions, and I will see you in the next one, that is your TDS and TCS.